Hi, this is Greg Wellborn, a principal at First Financial Consulting. In the past, we've delivered our economic and market commentaries in writing. This time around, we wanted to do it by video. I jotted down a couple of notes of some things I wanted to talk about today, and primarily they involve interest rates. They're back in the news because they're going to go up. The Fed has told us they're going to go up, and there are those commentators out there rather that are saying this is something we ought to worry about. We don't think it's anything to worry about. The Fed is no longer committed to being patient. That's the word that they took out in raising interest rates. And they're going very slowly. That's why they're focusing on words in their official statement. They'll take out an adjective here, they take out a noun here, they add a qualifier there. The reason for that is twofold, and this is important. First of all, the Fed, like any organization, is a political organization. And within the Fed, we have our rate doves and our rate hawks. Those group of the governors that want the rates to go up by more and go up faster, they're the hawks. The ones that want to keep it low or go lower, if that were possible, would be the doves. The Fed chairperson has to kind of walk the balance within the organization between those two camps. Secondarily, the Fed chair also knows that she has to walk at the balance between market expectations. Whichever direction the rates are going to go up or down, in this case it's going to be up, has to be done within some reasonable range of the market's expectation, or that's when markets panic. And we're not saying markets are going to panic by any stretch of the imagination, because we do believe that this is going to be done within the range that is expected. The bottom line here is that the economy is doing well, and therefore we're at a time when rates do need to rise. We had 3.6% in real GDP growth last year. We're looking at 4% this time around this year, even though we've had a little bit of fall off here in the first quarter. Let's take a look at recent history. What has happened in the past? Because I think that gives us a good insight into what we're going to see here in 2015. I want to go back to June of 2013. At that time, Federal Reserve Chair Ben Bernanke hinted that they were going to moderate quantitative easing. That was the word that they threw in. The press called this tapering. Well, what happened? It wasn't expected. It was a little bit too much of a surprise. Within a week, U.S. equities had fallen off by about 5%. The 10-year Treasury had shot up 40 basis points from 2.2 to 2.6%. A lot of commentators said market's going to crater, double-dip recession, end of the world as we know it, at least financially. None of that happened. In fact, the Fed held off a little bit, but then it did start the tapering in 2014. Actually ended up appointing a new chair, Janet Yellen, who finished the tapering in October of 2014. And what happened? Well, we all know, but here's some interesting statistics. Unemployment fell from 6.7 to 5.6%. The U.S. created 3 million new jobs. Real GDP expanded by 2.4%. Equity investors finally caught on to this. They realized that the economy is resilient. The S&P 500, including dividends, rose 13.7% to an all-time high. There was no fall off, there was no recession, there was no disaster. And today we've got the same issues and, funny enough, the same concerns. Now we're at the point where we're removing the word patient. We're indicating, the Fed's indicating they're going to raise rates, and people are saying, oh my gosh, the economy can't withstand it, the market's going to fall. Not true. Let me give you a little perspective on why that's true. Or I'm sorry, why that's not true, why the economy's not going to fall. A neutral Fed funds rate, a Fed funds rate that doesn't influence the economy one way or the other, is probably going to be about 3.5%. We're sitting here at 0.25%, 1/4%. We have a long way to go to get up to 3.5, where we'd be in the neutral range. Equities are going to handle this just fine. But if we want to get into the weeds, really look back over a longer period of time than just 2014, we can do that. And in fact, I put together some notes. We looked back on the last 12 Fed rate hike cycles. This went all the way back to 1954. We compared the S&P 500 index levels from 12 months before the rate hikes to, and then also looking 2 years after those rate hikes. Not only did markets not plummet, but in fact, they rose the year prior to the rate hike 10 out of 12 times, and the 2 years after the rate hike, 9 out of those 12 times. On average, the S&P excluding dividends, saw 6.6% increases the year leading up to the rate hike and 5.9% annual increases over the 2 years following the rate hike. This is not a recession. It's not doom and gloom. Now, we can't say today where the S&P 500 is going to go. I can't tell you tomorrow what it's going to be, even a month from now where it's going to be. But we start going out a year, even 2 years, we're very confident we're going to see it rise. And we're going to see it rise for some pretty good reasons. We're not loose, we're not tight, we're going to be in the neutral range for a while, anywhere around that 3.5, and we got a long way to go. We can also take a look at corporate profits. They're at all-time highs right now. The economy continues to expand at what we've called a plow horse economy rate. Not a racehorse, but this is also not a horse that's being shipped off to the glue factory. It keeps trudging on and on. The employment continues to gain steam. The other thing to keep in mind, and why we're so confident, is that raising rates like this is actually a positive sign. You think about it, the Fed isn't going to raise rates if they think the economy is in trouble, if they think a recession is coming, if they see those subtle signs, and they look at a lot of different economic activity, but if they see those subtle signs that say, uh-oh, we've got trouble on the horizon, the last thing in the world they're going to do is raise rates. So in a sense, the raising of rates, again at reasonable levels, which we believe they will do, but the raising of rates is a sign that the Fed sees positive economic news. And I've just ticked off a couple of the points that we look at. Corporate profits, unemployment, the growth rates. We're fine. This is not bad news. This is good news. It's probably going to stream over, I'd say, 2.5 years, because again, we believe that the Fed is going to be moderate in doing this. Probably not do it every single month, as sometimes they've done in the past. We would expect increases every other month, every other meeting, trying to meet the market's expectations, communicating to the market rates are going up, thus communicating the market's fine, the economy's fine, and we need to get back to a more normative historical range of Fed fund rates. So don't be concerned, don't be panicked. Look at this as very, very good news indeed. Thank you very much. I've enjoyed spending some time with you.